Scott Griffith, the former Ford executive and CEO of
$1 medium-duty EV market, or list.
Absolutely.
Thank you for joining us for this
Corporate entities that tend
material. There is certainly much more to solve that. By combining Motif software and
those are the absolute textbook characteristics of
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
On March 5th, 2026, Workhorse Group saw an aggregate total volume of 23,858 shares. Crucially, the off-exchange short volume was 17,742 shares. That yields a short volume ratio of 74.37%. Furthermore, in early March, the cost to borrow these shares reached a staggering 45.98 to 48.89%. All while the company's total market capitalization plummeted to approximately $7.53 million by March 3rd.
It is a really extreme set of data points to open with. You have market mechanics screaming one thing and the underlying equity valuation screaming another.
Exactly. And that brings us to the core intellectual disagreement we need to unpack today. Does the recent debt for equity merger with Motive Electric Trucks, a deal that essentially handed 62.8% ownership to billionaire Gary Magnus, does this represent a brilliant, tightly coiled structural turnaround for a $23 billion medium-duty EV market? Or does that astronomical short interest actually reflect a terminal cash burn and a company on the brink of insolvency despite its new governments?
Right, and that is exactly the tension here. Because, look, if you approach this from a position of strict financial realism, you look at that $7.5 million market cap and you see an accurate pricing of bankruptcy risk. You simply cannot ignore the February 25th, 2026 8K filing. That pro forma filing included an auditor's explicit substantial doubt warning about the combined entity's ability to continue as a going concern.
But that warning is standard for...
Let me just finish the thought on the fundamentals because it frames the short interest. A fancy chassis and a new boardroom cannot outrun a catastrophic fundamental reality. We are looking at a Q3 2025 earnings report that missed estimates by a mile. They reported a loss of $20.40 per share against an estimate of just $1.45. Pause. So the heavy short selling, it isn't some manipulated trap. It's a rational response to inherited indebtedness and a massive working capital deficit.
I understand the instinct to look at the Q3 miss and the going concern warning and call it game over. But I argue that the post-merger architecture is actually a masterclass in strategic consolidation. Think about the EV sector right now. It's littered with companies that have great ideas, but zero capacity to scale without burning billions. This merger solved that. By combining Motif software and their existing fleet relationships with Workhorse's massive 5,200 vehicle capacity at the Workhorse Ranch in Union City, Indiana, they secured order-linked survival.
Having a 436,000 square foot facility doesn't mean you can afford to turn the lights on.
True, but it means you don't have to dilute your shareholders to build the factory in the first place. And this is why the market microstructure data I open with is so vital. The float is heavily restricted now because Magnus's 6.6 million shares are locked up. That creates a coiled spring. Any positive execution will violently punish this incredibly crowded short trade.
Let's talk about that microstructure, actually, because I think people see a high short volume ratio and immediately jump to the conclusion of a short squeeze.
Well, look at the venue execution. The extreme dark pool in off-exchange activity is undeniable. We are seeing off-exchange execution frequently exceeding 70% of daily volume. On February 27th, it hit an 84.84% short volume ratio.
Yes, but
Just to clarify for everyone, this means that the vast majority of selling pressure is not coming from retail investors hitting the bid on lit exchanges. It is dominated by institutional internalization. Market makers are routing this off exchange, and because Motive GM Holdings 2, which is Magnus, holds 62.8% directly, the true tradable float is microscopic. That supply shock is exactly why the cost to borrow spiked to almost 49%. The shorts are trapped if Workhorse simply executes.
I'm sorry, but I just don't buy that. Let me tell you why. High borrow rates and heavy dark pool activity, those are the absolute textbook characteristics of microcap stocks undergoing severe structural distress. When a company's market cap drops below $10 million, liquidity evaporates. Market makers rely on institutional internalization simply to facilitate trades without breaking the public tape. It's not a conspiracy, it's just plumbing.
I'm not saying it's a conspiracy. I'm saying it's a structural trap.
But the $7.53 million market cap isn't an artificial trap created by dark pools. It reflects the deep caution of a market that is looking at a company inheriting a massive working capital deficit. It's an accurate pricing of the very real risk that they won't survive the year. You can have a restricted float, sure, but a restricted float doesn't pay your suppliers.
And that is exactly where the brilliance of the Magnus financing structure comes into play. Because they do have way to pay suppliers. The $50 million financing lifeline is not the toxic death spiral dilution we usually see in failing microcaps.
It's still debt.
Split into two highly disciplined tranches. You have a $10 million revolving credit facility for immediate working capital. Then, crucially, you have a $40 million asset-based lending facility, the ABL.
Which is highly conditional.
Exactly. It is strictly earmarked for supply chain costs tied to qualified purchase orders. This prevents management from just burning cash to build unallocated inventory that sits in a lot gathering dust. They have to go out, leverage Motive's relationships with North America's largest fleets, and get a signed order. Once they have that qualified purchase order, the ABL unlocks the funds to build that specific truck. It forces real revenue generation. Add in management's goal of $20 million in cost synergies by the end of 2026, and you have a roadmap to actual survival.
That's a compelling argument, but have you considered the actual timeline involved here? Because timelines are where EV startups go to die.
How so?
You mentioned the $10 million revolver for working capital. With the severe working capital deficit they currently have, plus the heavy expenditures associated with merging two distinct corporate entities, that $10 million is going to burn incredibly fast.
They are cutting redundancies, though. The R&D and G&A consolidation.
Yes. The projected $20 million in cost synergies, but let's be honest, claiming massive cost synergies by the end of the year sounds exactly like the desperate projections typical of a failing startup. It costs money to consolidate facilities. It costs money to merge IT systems. If they exhaust that $10 million revolver before they manage to actually ink those qualified purchase orders, then that $40 million ABL facility is completely useless. It remains locked. The bridge simply might not be long enough to reach the other side.
I disagree because the product is already proven. They aren't starting from scratch on the engineering side, which severely shortens the timeline to revenue. We have real empirical data on product viability.
You're referring to the W56.
Right, the W56 platform. They integrated the Utilimaster Aeromaster aluminum walk-in body onto their chassis. This is huge because fleet operators already trust the Utilimaster body form factor. It offers up to 150 miles of range, 1,200 cubic feet of cargo capacity. It's a direct, viable competitor to traditional internal combustion step vans.
The specs are fine on paper, yes.
But it's not just on paper. The Stables project proved it. They partnered with a FedEx ground independent service provider in Ohio, put these vehicles into real-world logistics stress testing, and reported a 97% uptime in Q3 2025. That level of durability data is undeniable. The fleets know the vehicle works.
I will grant you that the 97% uptime from the Stables project is a genuinely bright spot. It's solid operational data. Pause. But you are focusing solely on the engineering of the truck while completely ignoring the engineering of the corporation itself.
I don't think you can separate the two.
You have to, because the administrative and cultural nightmare of this merger is staggering. Let's go back to that February 25th 8K. It didn't just have a going concern warning. It also included a restatement of Motive's 2024 financials.
Okay, but that was just to correct a weighted average share count error resulting from their 10-for-1 reverse split. It was an accounting technicality.
It didn't affect the net loss, true, but it highlights the messiness of data integrity when you smash two struggling companies together. And let's look at the leadership. They call it a merger, but it's effectively a reverse takeover by Motive. Scott Griffith, the former Ford executive and CEO of Motive, is now the CEO of Workhorse. Matthew O'Leary from Motive is the chairman. 5 of the 7 board members are from Motive.
Which makes sense, since Motive brings the software-first approach and the fleet relationships that Workhorse desperately needed.
But you are tasking a management team from a company that also had its own historical cash burn issues to come in, take over a massive 436,000 square foot facility, integrate 2 distinct technical stacks, sort out restated financials, and do it all before a $10 million revolver runs dry. Integrating cultures and technologies is a monumental task even for healthy companies. For a company under an auditor's going concern warning, racing against a debt clock, it might just be impossible.
Well, I view that leadership change as the necessary stabilization of the ship. Remember, Workhorse was struggling so much they had to execute a 1-for-12.5 reverse stock split in March 2025 just to maintain their NASDAQ listing. Bringing in Scott Griffith's experience and having Magnus act as a highly disciplined lender of last resort is what allows them to pivot from being a speculative, retail-driven stock into a controlled, serious, medium-duty OEM.
A controlled OEM that required immense financial engineering just to close the deal. Let's not forget they had to amend a $5 million subordinated secured convertible note issued in August 2025, converting it into an unsecured obligation just to make the merger arithmetic work. That level of complexity usually breeds vulnerability.
It is a complex transition, absolutely. But it is a transition specifically designed to escape the doom loop of microcap EV startups. They now have the manufacturing footprint, they have the fleet relationships, and the software stack. Most crucially, they have that $40 million order-linked ABL facility that shields them from predatory dilution. If management simply executes on their existing pipeline and secures those purchase orders, the heavily crowded short trade in this microscopic float is going to face a severe reckoning.
Pause. And yet, the fundamental realities remain incredibly stark. While a software-first approach and massive facility in Indiana are theoretically sound assets, the sheer weight of historical cash burn is an anchor. You have ongoing restructuring costs, a working capital deficit, and a ticking clock. The market isn't setting an artificial trap at $7.5 million. It is accurately expressing deep skepticism that they can survive long enough to unlock that ABL facility.
Well, the ultimate test of both these theories is essentially on our doorstep.
Exactly. We are looking at the Q4 and full year 2025 earnings report, expected around March 30th, 2026.
That report is going to be the definitive catalyst. It will provide the market's first clean post-merger look at the data. We'll see if that $20 million cost synergy target is genuinely achievable and if they've managed to land the qualified purchase orders needed to top the ABL.
It will be the moment of truth for the balance sheet, without a doubt. And it highlights why we have to examine both the microstructural mechanics, the dark pool volumes, borrow rates, restricted floats, alongside the harsh, fundamental realities of corporate turnarounds. You can't fully understand the pricing without both.
I completely agree. It's the friction between those two forces that makes this such a fascinating case study. We will leave it to the listener to weigh the evidence and draw their own conclusions ahead of that March 30th catalyst.
Absolutely.
Thank you for joining us for this examination of the material. There is certainly much more to explore as the data continues to unfold.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!